Hello, everyone. Welcome to this November edition of The Pitch. It's the week before Thanksgiving. We are looking forward between now and year end and a little bit further to see what ideas bubble to the top of the minds of our three guest strategists. The goal of The Pitch is to exchange ideas, to bring ideas to the table, discuss them as a group. I have found, having moderated the show a number of times over the last couple of years, it has been a fascinating discussion, an opportunity to learn a little bit about how some experts are picking ideas, picking stocks, picking ETFs, but also what fuels those decisions. What information are they looking at, and how can you use those ideas to better improve your own decision-making? I want to welcome on our three guests. And guys, thank you so much for joining us. We have Julius de Kempenaer, founder of RRG Research and a valued member of the StockCharts team, now managing our data efforts, which is fantastic. We have John Kosar, the founder of Asbury Research, coming to us from Chicago, frequent guest on StockCharts TV, including the Your Daily 5 show, which he guest hosts. And Jeff Hughes, the founder of JWH Investments, coming to us from Minneapolis, also a frequent face and voice on StockCharts TV. Gentlemen, welcome to the show. Thanks for doing this today.
Great to be here, Dave.
It's good to see you all. Let's start to get through the pitches. As a reminder, everyone, here's the format. The first half of the show is sort of the rapid fire pitch discussion. I'll start with Julius, then John, then Jeff. We'll go one pick at a time and get through the 15 ideas and talk briefly about them. At the end, we'll then have time for a discussion. We'll really think about what sort of lessons we can pull out and questions about process and decision-making, all the above. Julius, are you ready to get us started?
Got it going.
We are going in the consumer staples sector to start with. Monster Beverage Corp. We have your monthly chart to start with. Let us know what's going on.
Yeah, obviously all my picks are based on an RRG affiliated process. We can get to that later, but one of the stocks that popped up in when I reviewed it was Monster. And I've decided for this episode to give for every stock a monthly chart and a weekly chart, because I feel we are now in a period where sometimes the weekly chart will give you a signal or an idea. And when you look back on the monthly, it will either get completely negated because it went the other way, or it will be confirmed. And with Monster, I think that we're in a very strong position there because it is pushing to that really heavy overhead resistance. That's a 2-year overhead resistance, and we're really close to pushing above that barrier. When that happens, that stock pushes to new all-time highs. And when you push to new all-time highs and you've got a pattern as the one that we've got there, and if you switch to the weekly now, we can see that in a little bit more detail. I think that what we see here is a complex head and shoulders continuation pattern. And I actually, because I wasn't entirely sure whether that was allowed. So what I did is I actually picked my Bible and I looked in Edwards and McGee, and they have like 6 or 7 pages where they explain multiple head and shoulders patterns, where the pattern has multiple shoulders and one head. And I think that's exactly what we're seeing here. So if and when that thing breaks, let's round it off to $100, you're looking at 30 to 35 upside potential for Monster. So that's my first pick. And it looks very good on an RRG.
And the big round number right at $100 a share.
Exactly. Yeah.
So we just got started. You've already dropped the Bible of technical analysis on the group. So thank you for that. Thank you for that, Julius. We're starting with a firm foundation in the technical analysis toolkit. John Kosar, thank you for joining us today and doing this a number of times. You're always a very helpful, valued guest on the pitch. Your first chart is the financial sector. What's the idea here?
Well, I started with the idea because our SEAF model, which is a sector ETF asset flows model, showed that there were an aggressive amount of assets in multiple time periods at the end of October that were going into financials. So we took a look at that. So what I have on the chart is you can see on October the 31st was when that showed up on the model. The model's updated once a week. And it shows that we were right underneath the 200-day moving average, as you can see there. Took about a week, and now we're through the average, and we're actually up against the August 16th high at 35.97. 34.66 is now the support level based on the 200-day moving average. That should hold. If this idea is going to keep working, it's I think XLF is up about 6% top to bottom since our signal showed up at the end of October. And then the other thing down at the bottom, you can see the relative performance of that really took off right at the end of October. We want to see that continue. The third thing that I didn't put on this chart that might be the most interesting of all, the reason I didn't is because it goes way back. This 30.95 level in XLF, that was effectively the high in May of 2007, in January of 2018, and in February of 2020. So those two tests that we had on July the 14th and October the 13th were basically more tests of that big level. So when I put a trade on, I like to have something longer term to lean on, and this certainly fits that.
Really interesting. This is such a great chart. We'll probably revisit this in the discussion, but this is one of those kind of perfect examples when I think about this rally off the lows. This chart either breaks out and it's this beautiful follow through, or it fails to hold the 200-day moving average. I think that could be a really interesting binary outcome for the chart and for the markets too, right?
Yes, and the risk reward is great there too. That's the thing, is trying to find a place to put a new idea on where the risk reward is good. And we certainly have that here, I think.
I love it, John. Great start to it. We're sticking with ETFs. Jeff Hughes, thank you so much for joining. Again, you've been a frequent guest on the pitch. I always describe you as one of my favorite stock pickers because you always just have this great perspective on how these movements relate and thinking of the appropriate timeframes. Gold is bullish here, apparently. Talk us through the trade.
Yeah, so we're looking at GLD, which is the tradable ETF proxy for gold. And normally, as you know, I use weekly charts. This happens to be a monthly chart that goes back to 2016. And one of the things that we noticed was the very predominant three-wave corrective sort of form of the most recent, 2-year, 2.5-year period. And it got us thinking about, that possibly being a fourth wave in a larger degree trend. And so we set the Wayback Machine to 2016 and started to count this in an Elliott wave format, where it's 5-wave advances buffered by 3-wave interruptions, corrective patterns. And when we got to the 2020 high, we got to wave 3. And so that's not the end of the advance. There's another 2 waves, a wave 4 and a wave 5 before we complete. And so when we look at this period of time that, began from the 2020 high and just recently bottomed, in our opinion, that counts very well as a regular flat pattern. 335 is the count, ABC is the labeling, and that precedes wave 5 advance. Now, the thing that's really caught our attention is the large monthly candle that has reversed above the short-term trend, the trend line from wave B to wave C. And that, in our mind, is the beginning of a smaller degree 5-wave advance, which will ultimately be wave 5 of this advance, which should carry the market to new highs for GLD. So GLD is trading around 163 right now. There's a gap, an unfilled gap at 168. I think if we get above that level, it will confirm the reversal. And from my perspective, that should take the market, or GLD, to new all-time highs. Now, if we're wrong about that, the stock should not make a new low. So we set our stop loss at 150, and that gives us a pretty good 3-to-1 positive risk view for the trade. I'd also point out that in the upper panel, we can look at 10-month momentum, and 10-month momentum is breaking out. And so I think that that's pretty good confirmation. If the month closes above that trend line, it will be confirmation. And then on the lower panel, we can see that relative strength versus the S&P 500 has turned up for the past several months, and it seems to be accelerating precipitously higher. And so, from my perspective, relative strength and momentum are both confirming this expectation of a new all-time high in GLD.
Gold has had a tough 2022, as most things have, but it's outperformed the S&P, which is notable. Nice bullish case there, Jeff, and thanks so much for talking through that. Julius, you are back up with your second chart. You're staying in the same sector, consumer staples. This is Walgreens Boots Alliance, WBA. What's the idea here?
Yeah, so this is a perfect example of where we see that market coming down. It's in a broad range that's about almost 3 years running now. We just dipped below that support and then reversed back up. And that's one of the things that triggers me. When a market dips below support, refuses it, and then comes back up, that's usually works like a spring, like it flashes the other way. And then we get out of that falling trend channel. So I think that just based on this, it's already quite bullish. And if you look at the relative strength in the RRG lines in the bottom panels, they have turned up. That positions WBA inside the improving quadrant on an RRG. And if we now go back to that monthly, because that's where I was is that really an important level? Then you can see that we're back up that former low, and it's also in the range of where we have that cluster of highs and lows in 2012 and 2013. So within that longer term time frame, I think this could go up to upper boundary, let's say 55, maybe 57.5, upper boundary of that range. Combined with the relative strength, the bounce of that support level, the little reversal back up, I think it makes a good case. And it's just the opposite of Monster that we spoke about, because Monster is pushing against overhead resistance and trying to break higher. This is testing support and bouncing off it. So
I love it. More of a mean reversion play coming off the lows there. But I love that illustration of the failed breakdown, right? You push below and then there's no follow through. Great example, exactly. Julius. I love that chart. John, we're to your second pick. We're going big picture. This is more of a sort of tech, sort of themed play. The Nasdaq Composite stock is a Fidelity tracking stock, ONEQ. What's the idea here?
I chose this because there's a lot of talk whether this is a bounce in a bear market or if this is the start of a rally that's going to stick and maybe take us into next year just for the overall market. In order for the market to do the latter, it needs some leadership. And the obvious place that you get the leadership from is tech. So I'm really interested in what goes on here. So what we have, first of all, 38.39 is the February 2020 high, which is right around those three lows that we made at the end of September, the middle of October, which was the bottom, and then the 4th of this month. That looks like a emerging inverse head and shoulders pattern to me. Not quite there yet. You could see we broke out on the 11th of November, couldn't hold it. It's just the market isn't quite sure what it wants to do here. You've got the 50-day moving average, which is right underneath at 43.12. And then you've got a neckline here at 44.03. And if you look, I mean, we've been underneath the 50 days since September. The market obviously sees it. It took a couple of runs at it during that period. It couldn't break it. So to me, if we fall back below 43.12 and stay there, that's a failed breakout. And we're going to have more weakness going into the holidays. If we can hold 4,300, let's call it, and get back over this 44.03, now we've got to run up to 47.67, which is a 200-day moving average and major resistance. And the target on that pattern, actually 48.50, it implies will break to 200. So I try to find a little window where a lot can happen. And I think this is one of those instances.
Interesting, and would line up with the seasonal tendencies where tech, other growth sectors tend to do pretty well going through year end. It's an interesting chart as well. Jeff, we're to your second chart. We are going to biotech. First pitch in the healthcare sector. What's the idea here?
Yeah, we like two different types of patterns, breakouts and reversals. This is an example of a reversal pattern. We're looking at a 3-year weekly chart in the IBB Nasdaq Biotech tracker. The two heavyweight stocks in this are going to be, I believe, Amgen and Biogen. but there's a handful of them. Gilead's big, Regeneron, a few others, show up as pretty, key holdings. So, there's about 10 stocks that represent, something like 60% of the index, and the rest are, very small secondary stocks. But I think the point here is that we are seeing some significant evidence of a reversal developing here. We've taken out the weekly downtrend and the moving averages, critical moving averages here, where you're using a 10-week and a 20-week. And then we're also putting in a classic pattern base formation, what I would describe as the head and shoulders variety. And with that, we're seeing positive momentum in the upper panel and accelerating and positive relative strength in the lower panel. So these are confirmations here. And so the setup that we see with the ETF trading around 132 today is a sustained breakout above 136 would project a measured move from the head and shoulders pattern to at least 166 and potentially higher yet. There's another measure that we put in place that would actually take us to 181. So we think there's plenty of upside here. But just in case we're wrong and the pattern fails, we like to protect our downside. So we would recommend putting a stop loss at 126, just below those moving averages there. And that would set up a positive or a 3-to-1 positive risk skew for the trade.
I love that. And so close to confirmation. It reminds me of John's previous chart too. Very, very close to sort of giving that, what I guess you'd call that trigger, right? Getting above, getting out of that pattern, resolving to the upside. Great illustration of a potential bottom in biotech there, Jeff. Thank you for that. Julius, we're back to your third pick. We're now going to the materials sector. PPG, exactly. What's the pitch here?
Yeah, well, when you look at that monthly chart, that is not giving us a lot of information. The only thing that I'm reading from that is that we had that irregular broad range from 2015 to 2019 until we got that big swing when Corona started. Then we had the rally, and we very recently dipped to 110, which is kind of in the middle of that broad range that we had for about 5 years. The reason why this stock showed up on my RRG approach is because of the weekly version of the chart. And if you look at that, you can see that the RRG lines are close to 100, but they're curling. They're both starting to curl up, which puts it at what we call a positive RRG heading, which means that it's picking up on both axes. So it's traveling in that northeastern direction. And you can also see in the raw relative strength line, just the ratio between PPG and SPY, that seems to be coming out of a broad trading range. And if we then go to the price chart, you can see that we have something which could qualify as a range, or when we take out 135 as a completed double bottom on a weekly chart, which has lasted for 9 to 10 months. A little bit of overhead resistance left between 140 and 145, but when this one gets out of 135, above 135, I think you got about $20 upside potential, which will eventually bring it back to the all-time highs near 175, 180. So combined with the relative strength, the potential breakout out of this range, the industry, not to forget, the materials industry is doing pretty well in itself on a relative basis. So all in all, one of my picks in the materials sector right now.
I love it. I'm getting from a number of you, I'm jotting down some of these tickers and alert levels to set after the show, which I will do because there's some really actionable levels you guys are highlighting. I appreciate that. John, we're to your third pick. We're keeping it sort of big picture and talking about small caps, which have had a bit of a run and nice relative outperformance. What's your take on this chart here?
Yeah, this one's interesting to me because this is another one that you'll typically see lead the market if the market's healthy and we're in an uptrend. So what we have here is we held the June 16th low in September 27th, and then again on October the 13th. So you've got a little double bottom there that basically projected up to the 200-day moving average. So we got that. Now inside, or I guess outside, if you look at those two lows in September and October, and then we have shoulders, September 6th and November the 3rd. You have an inverse head and shoulders pattern. In order to break out of there, we need to get through the neckline is at 185.90. The 200-day is right on top of it at 185.95. So you got a cluster of a couple of important areas there. So we broke out just like just like the last chart, the 1Q. We broke out for 2 or 3 days. Now we slid back under it. So the trick is, what do we do here? If we break back through these November lows, we're in trouble. We're going to probably revisit that support line, which actually originated from the June 16th low. So the flip side of that is we get back up above 186 and we keep moving. We have a 210 target on this inverse head and shoulders, which would effectively put us back at the August 16th high. If we take out the August 16th high, now we have a larger double bottom from the June lows and then the lows that we had in Sept-Oct. And that, so like one pattern trips into the other here, and we're in this tight little window right underneath. So again, a little window here that can give us a significant move either up or down.
It's really, really good. Patterns within patterns almost as you're talking through it, right? But really interesting levels to pay attention to right now. Thanks for that, John. Jeff, we're to your third pick, which is PACCAR, PCAR. What's the idea here?
Well, again, we like to trade breakouts or reversals, and PACCAR is a classic example of a breakout here. There's been a lateral consolidation pattern, and just to be clear, you're looking at about a 3-year weekly chart here. And PACCAR has been in about a 2-year classic pattern base formation of the double bottom variety. It's taken out a minor trend line and it's taken out some minor chart resistance levels, but the key level was at $98. With the stock at 102, we think the breakout above the prior weekly high of 98 sets up a measured move from that double bottom base to at least 129. And, we're looking at momentum as confirming. Momentum's broken out. It's positive. We're looking at relative strength in the bottom panel. Also, it's a leading stock. It's leading its industry group, its sector, and the market at large. And momentum is relatively positive here. So, our thinking is that for swing traders that have a 1 to 3 month period of or time horizon, you can buy the stock here, set a stop loss at about $98, and that sets up a very attractive 5-to-1 positive risk skew for PACCAR on the upside.
I love the chart, and thanks for highlighting the relative strength. Some nice improvement as it's breaking out of that resistance level. Very, very good. Julius, we are to your fourth pick. Same stock. This is the only time when we had an overlap. I like to let it all happen independently. You guys ended up at this name together. How do you compare with this particular chart?
I was going to say next, please. I mean, I think we can safely conclude that Jeff and I both use RRGs pretty heavily. So that's no surprise that it happens. So from the weekly chart, keep that weekly chart up there because the annotations are pretty similar. The RRG lines are obviously pretty similar because it's the same stock. What triggered me, I'm going to add to Jeff's story is when I see a chart like this, and there is this saying that never confuse the bottom of the chart with support, but I'd like to also reverse that. Never confuse the upper boundary of a chart with resistance. So what I do in this case is I flip to the monthly chart to see I'm always wondering, is this really the all-time high or is there some all-time high way back? And then this is what you get. And you can see that with my other charts, I had a bar chart up there. If you bring up the bar chart of PCAR, then you will find that, especially in that last section, where I have that little triangle, that the bars are kind of noisy. They're quite long and there's no real nice, you can't really draw a nice line and connect any dots. So when it gets confusing like that, what I like to do is go back to the basics and just draw a line chart. Just get that line chart there. And then it's almost like you see that as lo and behold, and then you see this. It's like, wow, this is you got that rising support line's got 5 touch points on monthly closing basis. That says something, at least says something to me, especially when you can draw that upper boundary that has then 3 touch points, 3, 4 if you take the last one with it. which is also a very reliable line. It gives us a nice rising channel. And then at the end, we get that consolidation that takes about a year. Call it a triangle, whatever you like, but we break out of the triangle and we're now breaking out to the upside of an already rising channel. And I always label that as a very aggressive move. When a stock breaks out of an already rising channel, that almost always gives you an acceleration, gives you a little extra push. So that 129 level that Jeff is mentioning, yeah, totally agree with that. And this is probably one of the better stocks inside that industrial sector, which is already doing pretty well by itself.
A lot of interesting charts in industrials. You guys have highlighted one of the better breakouts for sure. I love this monthly chart, and it reminds me, one of my analysts at Fidelity, Darren Chabot, always had a little monthly chart on his regular charts, and you're reminding me why that is so important to think about the long-term trajectory. Great example there, guys. Thanks for going through that one. John, your fourth chart is the metals and mining ETF XME. So we're in the materials sector here. What's your take?
Well, as you can see, I'm keeping it kind of big picture. I think this is really big. I think this is an important level just for markets in general, as we decide whether we're still in this negative phase or if the sun's starting to come out and we're going into something that's going to take us higher for a few quarters. So the first thing on this chart is up top. January 2018 high is at 39.12. So you can see we came down in July the 6th, and then again on September 25th, couple of tests there. Inside, on either side of the September 26th test, you can see there's a shoulder on each side of that. That's one, and the other one is right there, correct. And we broke out of there, again, kind of a tentative breakout, but if we hold that breakout, which is effectively holding 4706, which is the 50-day moving average, that takes us to 6750. If we go to 6750, we have a larger double bottom, again, off of that high that we made way back in January of 2018, and that can take us, just eyeballing it, up to 75, 70s, something in that neighborhood. And the last thing that I didn't show here is I track the asset flows going into about 120 ETFs. And the asset flows started expanding pretty aggressively in XME at the end of October, middle to end of October. So that's the push that I need. That's the horsepower. That's the conviction that makes this work. So if we get above 50.84 and stay there, which is a 200-day moving average, I think we have an opportunity to participate in what seems like a resurgence from the material sector.
I know that's a great part of your process, John, looking at the flows, right? Following the money, following the flows, and highlighting one of these where you're seeing inflows into the ETF is super valuable. Thanks for that. Jeff, what's your fourth chart? PFGC, Performance Food Group. What's the pitch here?
Yeah, this is a little bit longer term chart. We're looking at a 5-year weekly chart. PFGC is at the precipice of a breakout. And so we like the setup in the stock. It's taken out a minor downtrend line. It's taken out minor chart resistance, and it's up against a more significant multi-year weekly closing high. And if we can break above that weekly closing high at about $60, that would initiate, in my opinion, a rally to at least $82 and possibly upwards of $101 based on the larger base to the left of this initial base. And so that's the reason I wanted to include a longer degree chart so we can kind of see how we had this COVID crash in this stock, right? Because this is a company that distributes food products to restaurants and movie theaters and airports. And guess what? All of those businesses were shut down, and so was their business as a result. But the stock's come back and it's made a new high. And post that new high, it's put in what I think is just a classic pattern-based formation. I didn't want to get too creative with the way you draw the lines, but there's a base there, and it looks like it's on the precipice of breaking out. You've got decent momentum, solid positive momentum that also appears poised to be breaking out. You've got decent relative strength that's turning up and accelerating to the upside. And this is a stock that's outperforming its group. It's outperforming its sector. It's outperforming the mid cap and the S&P 500 indexes. And we think that there's a good shot that this stock could rally to our initial target of $82. Now, if we're wrong, we want to definitely advise traders to protect their capital. And so, our stop loss would be recommended at $55. Buy the breakout, set an initial stop loss at 55. That sets up a 4-to-1 positive risk view for this trade. And we think if it works out, you'll be happy.
Really interesting chart. Another one, I mean, classic sort of a consolidation pattern, just getting ready for that breakout above 60. That's a really good example. Thanks for that, Jeff. We are to everyone's final picks, and then we'll discuss and debate as a team. So, Julius, you are first with General Electric, GE. What's the take here?
Yeah. Again, let's start with the weekly here, because this is another one where you want to scroll back. So this is what, it showed up on an RRG as potentially interesting. It's a stock inside the industrial sector. As you can see, that red strength line is turning around. That's confirmed by the RRG lines, which are both above 100, which means that it's inside the leading quadrant and pushing into that northeastern direction. And then when you look at the price, it's almost a perfect double bottom that's been completed already last week, and we're still holding up this week so far. So that gives us already a pretty good idea that this stock is turning around. Now, the big fat red lines I've drawn in basically after the fact, because I had this chart and I thought, you know what, I need to check whether this is taking place within a longer term pattern. And that's when you got that monthly chart. And then lo and behold, you can see that the 2009 low is almost exact. It's to the dollar to the lows that were formed in 2020 and 2021. Anyone who tells me that the market has no memory, I challenge them to look at these type of charts, because this happens all the time. It cannot be a coincidence. So when you see that, I get more trust. I get more convincing that this is actually forming a low, especially because on this monthly chart, the stock didn't even reach that support level. It's putting in a higher low now, and then combine that with that nice double bottom on the weekly, I think we're in for a rally to at least that upper boundary there, which is around 110, 115, I guess, 115. From the 85 where we are right now, it's a pretty nice move.
Another strong chart in the industrial sector, Julius. Thanks so much for highlighting that one. John, we're to your final chart, staying in the materials sector for you, the silver miners chart, SLVP. What's the take here?
Well, the first thing is when I see a setup in one part of the market, I like to see similar setups in other parts of the market to tell me I'm not looking at a one-trick pony. I'm looking at something that's happening a little more broadly. So that's why we're looking at the silver miners here. So what we have, again, is another inverse head and shoulders, September 1, Sep 26, and October the 19th. We had a breakout on October the 26th. And we also have some strong resistance here from the May 12th low in middle of the chart. So again, I like to see a cluster of resistance areas broken to the top side to tell me that it's not just one person that saw this pattern. I want to have a lot of evidence that this is really apparent that this is important. So you can see we got through it again, just like ONEQ and just like IWM. We spent 3 or 4 days up above it, and now we sunk back down under it. We're starting to come back here at the end of the day today. As long as we hold 929, I think, which is a 50-day moving average, which you can see has really defined the move here since April, both up and down. So the market sees that. It thinks it's important. If we can hold that, that targets a move to 1175. 1175 is going to break the 200-day moving average, open the door to go higher. Again, looking at asset flows, total net assets invested in SLVP started moving above their 21-day moving average, which is monthly expansion for me back at the end of September. So there's some horsepower underneath there. And finally, if you look at the relative performance chart underneath, I almost forgot that. That's important too. Why buy something if it isn't beating the S&P 500 is how I look at it. So we had a nice move of quarterly outperformance as of September the 29th, 63-day moving average, came down to kiss it twice, October 19 and November 2. So again, small risk and big possible reward on the upside.
That might be the quote of this episode, John. Why buy something if it's not outperforming the S&P 500? Well said, and thank you for that summary of relative strength investing. Beautifully done. We are now to, Jeff, your final pick. Diamondback Energy, the only energy stock that is being pitched today. Talk us through FANG and what you like here.
Yeah, first of all, the symbol is FANG, but that's not to be confused with the FANG stocks by any means. In fact, it's quite the opposite. Tech ranks very, very low in our sector work. I think it's number 10 out of 11 sectors in our sector work. Energy, on the other hand, ranks number 1. And, no stock really jumps off the page at us more than this, mid-cap producer Diamondback Energy, which is in an uptrend and is breaking out to new all-time highs. The stock has recently penetrated a minor downtrend line and a major chart resistance level. And I think, that level at 155, if the stock can sustain above that level, it counts up to about 215. That's about 60 handles above the breakout level for something north of 35% return on your money. So I think it's a really good opportunity. The stock has strong momentum, as evidenced in the upper panel, and it is leading in terms of its relative strength, as I mentioned. So we like the setup here, emerging from kind of a small lateral consolidation. I would, however, be cognizant of the fact that the stock trades with crude oil, and crude oil is very, very volatile. And the Biden administration is continuing to drain the SPRs until early December. And I think once we get through that SPR drain, then crude oil can continue to start trading on its own merits, and that may help lift the stock. But if we're wrong about this whole thing, we want to protect our capital as usual. And so, we're suggesting a little bit tighter stop on this at 149. That sets up an extremely attractive 10-to-1 positive risk skew. So, even though energy is extended, everybody's long energy at this point. It's almost a watched pot at this point. I think the risk return opportunity here is exceptional, and I think it's worth the risk.
What a strong way to finish the 15 pitches with energy by far this top performing sector in 2022, and some more upside potential, Jeff, according to your toolkit. Guys, that was awesome. Let me recap these picks for everyone watching, just so we can review and reflect on what you guys all shared with us. Julius de Kempenaer, founder of RRG Research and a valued member of the StockCharts team, gives us 5 pitches. We have within the consumer staples sector 2 stocks, a monster beverage company, MNST, and a drug retailer, Walgreens Boots Alliance, WBA. We then go to the materials sector for PPG, and then 2 industrial stocks have come on very strong here recently. PCAR, PCAR, and then General Electric, GE. John Kosar, founder of Asbury Research, coming to us from Chicago, gave us these 5 charts, all ETFs this time. We have the financial sector spider, XLF, the Nasdaq tracking stock, and I have to shout out to my Fidelity colleagues, if I remember it, because it was pounded in our heads as Fidelity employees. That was the first index tracking stocks, pre-ETFs. ONEQ is actually the first one that tracked a major index, if I remember right. So ONEQ, thanks for highlighting that one. We then have small caps, the Russell 2000 ETF, IWM, coming on strong recently. Then 2 plays in the materials sector, the metals and mining ETF, XME, and the global silver miners ETF, SLVP. Finally, we have Jeff Huge, founder of JWH Investments, coming to us from Minneapolis. Couple interesting different sectors you touched on here, 5 different areas of the market. We have in the material sector, GLD, the direct play essentially on gold prices. We have the biotech ETF in the healthcare sector, IBB. PACCAR, the only stock or chart that 2 of you overlapped on, PCAR in the industrial sector. In consumer staples, PFGC, Performance Food Group, and then Diamondback Energy, one of the top performing names in a top performing sector, ticker FANG. Those are the picks we had, guys. That was awesome. And you dropped so many nuggets of investment wisdom. I was jotting down as quickly as I could, because that was a half-hour masterclass on how to pick stocks and how to think about risk reward. So thank you guys for being very good at what you do and articulating those ideas very, very quickly to us. Julius, if I could start with you, because the relative strength came up a number of times as we were talking about as we were talking about these charts. You and Jeff both highlighted the RRG, indicator, and basically putting it on the chart. But really, the foundation of your approach and where a number of us use is thinking about rotation. Rotation has been pretty important in 2022. Can you give us an update on basically how you identified your stocks and what you're seeing using the RRG today?
Yeah, so my starting point was the RRG for the 11 S&P sectors. So that's basically the default one. Don't do it on this one because you'll lose your selection. Just create another tab if you wish. And what I see on that rotation right now, there's good momentum, good relative strength for materials, for industrials, and for staples. So that's where my picks came from. So you can see materials inside the improving quadrant. So that's a very nice moving tail. You got industrials, which is inside leading, not too far ahead yet, so still moving in that right direction. And then you got staples, which is kind of hit it exactly. There it is, rotating from weakening back into leading. And those are usually very strong rotations, because that means that staples is in already an established rising relative trend, went through a setback and is now coming back to it. So that's usually a very good sign. So I focused on those three sectors and then basically pulled up the individual stocks of each sector using an RRG, going over the northeastern directions. That's what I usually look for the strong headings. Picked out my names, and those are plotted on this chart. So this is the selection of individual stocks out of these three sectors that I thought, based on combining the movement of the trail and what I saw on the chart, that could make it to the list. So this is a little bit of my extensive list for today. And then I went over the individual charts, looked at the sector. So I usually have my RRG on one tab and then the price chart on the other tab, going back and forth to find out what I really like. And that's how I came to my 5 picks for today.
Yeah, I love that walkthrough, Julius. So starting sort of macro and going to micro, right? Starting with the sectors that are looking attractive, and then looking at some of the names that are part of that. John, when you think about your process, how much of it is more macro driven? And I know when you have come on my show, we've talked about the Asbury 6 model and sort of the overall conditions, market conditions. How does that inform your selections today, or is it more just a bottom up? What charts look good at this particular moment? How do you think about that?
I think I start with the short term, which is probably different than a lot of people. Our Asbury 6 went back to positive on October the 18th. So that told me, I look at the Asbury 6 as when you go to the doctor's office and he takes those 6 tests to establish your baseline health. It takes your blood pressure and he checks your reflexes, because your baseline health might be different than how you looked when you walk in the door. So once I know that internals are strong near term, then I start looking around for setups. And you saw a lot of these where I'll see a setup on a short-term chart, and then I'll expand that out to a monthly chart and see if there's a reason why that setup is there. Like maybe it's an old high or an old low or a trend line from 7 years ago. That gives me more to lean on. That gives me something more solid, a bigger anchor that I could lean on to put that position on. And if it works, a better chance that it's not going to be a 3-week play and maybe a 3-quarter play. But it all starts with the A6, the Asbury 6 kind of indicators, to make sure that the internal health of the market is strong enough for me to even be looking for buy ideas.
I love how you related the Asbury 6 to like going to the doctor, right? Doing sort of the check. It's funny, when I was at Fidelity, we used to compare meeting with the technical team, like taking your portfolio to the doctor for a wellness check. The problem is a lot of people apparently don't like going to the doctor, so I had to change that pitch. And once I compared it to going to a personal trainer, then I got a lot more buy-in. So I guess
maybe go to a bar or something. Right?
I'll have to work on my salesmanship for technical analysis, but no, it's a great illustration. Jeff, when you're looking at a chart of the S&P, where a number of you in your discussion sort of highlighted how we're kind of right at that point where either this all of a sudden looks incredibly good, or it looks like this sort of failed, the end of an incredible move off of the lows. When you're thinking about the S&P and the Nasdaq, how do you delineate between the two? What are you looking on this chart to sort of help you figure out what's next here going forward?
Well, I'm a proponent of the Elliott wave principle. And so it is a decent guiding, roadmap to how stocks should behave based on their past performance. Okay, and so we use that framework to identify the trend. And once we've identified turning points in that trend, we begin the count from that turning point. We identified the January top as the end of at least cycle wave 5 of potentially a super cycle degree advance that went all the way back to 1932, a GAN 90 years cycle advance. And those are rare, right? No one's ever seen one before. So we're a little bit out on a limb here with that call. There's no question about it. A lot of people have given us a tough time over it. But I'll tell you this, as we count down from the January high, we can count 5 waves down at intermediate degree, 3 waves up at intermediate degree, 5 waves down at intermediate degree, 3 waves up, and another 5 waves down at intermediate degree. And that gets us to primary degree wave 1 down by the time we got to the June lows. And so that is a larger degree pattern that requires a larger degree correction. And so the advance off those June lows into the August highs counted in 3 very identifiable waves that again look to us to be primary wave 2 of a larger degree 5 wave decline. And so from that level, we've counted 5 waves down into the October lows, and we're now counting 3 waves up from those lows. So we've got intermediate wave 1 down and intermediate wave 2 up of the next degree, primary wave 3 down in our thinking. Now, our count could be wrong, Dave. The whole thing could be wrong, and maybe it wasn't primary wave 1 down. Maybe it was wave A, and maybe it was not wave 2, is wave B. And so we might have a big ABC. And the only way we'll know that for sure is if we take out the August highs. That is the line of demarcation for our way of thinking about the big macro picture in the market. Until we take out that make or break, we have to consider this a bear market rally. And once we break below the October lows, that's confirmation of a third wave down in progress. And the next move lower is going to be substantial. It shouldn't be ignored. I think it's too early to call the bottom, in other words.
Yeah, it's interesting. Another way, as we've thought about, is this a bear market rally or not? I mean, another way to think of the chart of the S&P is we're at the same level we were in May. We've had a lot of noise, but at the end of the day, we haven't gone anywhere directionally since May. It's sort of a 6-month sort of choppy, noisy way to not go anywhere on a bigger picture, right? Really, really interesting. As we're continuing on here, wrapping up the discussion, John, we have the Fed meeting coming up in a couple of weeks. We just had the Fed meeting here recently. We had inflation data. That sort of macro, those drivers can certainly cause a lot of shifts. And in the last couple of weeks, we've had a lot of news-driven movements, but a number of them related to inflation and related to the Fed. When you think about the markets going through year-end and really into the first quarter, how big of an issue is inflation and interest rates related to what we're talking about from a technical perspective? How do you relate sort of the macro, Fed sort of speak relative to what you're seeing on the charts?
I think it's enormous. I think that's probably the single biggest driver of what's going to happen. 4.1% for me in the yield of the 10-year was a really important level. The market obviously saw it. It's been trading on both sides of it for a month, and now we're back underneath 4%. If we start trading up above there, in other words, if the yield starts moving back above 4.1, stays there, that next level is the next large level. If you're looking at TNX or if you're looking at the yield of the 10-year, is up in the 5s. It's a 5 handle, maybe 5.4, 5.5. I don't have it in front of me, but the way the bond market trades, seemingly for someone that's been looking at bonds for a long time, is it will sit quiet sideways for months and months and months and lull everyone to sleep. And all of a sudden, bam, something happens and we move 50 basis points and it hits everyone like a punch. So I think watching 4.1 in yield is going to give us a very 32,000 foot view of maybe what expectations are from the Fed, what expectations are for inflation, how well we recover, if we're going to have a soft landing. So I think that's one point to watch.
It's a really interesting take, John. I don't know if you guys could probably see, but one of the two paper charts on my wall back there is the long bond yield going back 50 odd years. And it's just a reminder that trends in the bond market can last for quite a long time. And I know a lot of people have said, boy, rates have gone up to 4%. Can they go much further? And my answer is, yeah, they can go a lot higher. Theoretically, they could go much higher than this. I don't know if we're going to go to 15% on the 10-year, but we certainly can go above 4.25 for sure. Julius, I wanted to ask you a little bit about timeframes, because you are the only one to bring multiple timeframes of each chart. Although we all sort of address the different timeframes for sure, but you did a really good job of sort of highlighting the monthly and the weekly. And then when we use the RRG, when I use it, and when I know when you do, you look at different timeframes. Why is that so important right now as we're trying to process what's happening in 2022?
Okay, I'm going to answer that question in a minute, but first I have a question for you. You said
Perfect.
let me phrase it. The question is, do you believe everything they told you at Fidelity?
Wow. I'm no longer under contract, so I could probably say no, not really.
Because you just said that Fidelity claims that ONEQ is the first tracking stock.
Yes.
And I just looked it up because I thought that's not true.
Yeah.
And I did a fact check really quickly.
And
ONEQ started trading on the 25th of September of 2003.
Fair enough.
You know what happened on the 22nd of January in 1993?
What's that?
SPY.
You know what it is? I think what it was, I think it was the first Nasdaq tracking stock, because the Qs came after. So there we go.
All right. There's a subtle difference there.
I am vindicated. Okay, there we go.
Back to
Fact
time
check
frame.
complete.
Well,
now quit asking a question and answer mine, Julius.
This has everything to do with time frames, and the reason why I think it's so important, because you can be blindsided if you just look at one time frame.
Yeah.
I think our discussion that we had at ChartCon, when we did the little gig with the AWACS and the planes that we were going to deploy, that's a perfect example, because when you look at that daily chart, or maybe even worse, intraday traders that look at 60 or 30-minute charts, they are not capable. They can't see the bigger picture that is shaping up on a weekly or a monthly chart. So they may see a breakout on an hourly or a daily chart, which looks great on that chart. But when you get to the weekly or the monthly, you can see that massive barrier of resistance over there. So you're buying a breakout because it's trading $1 over resistance, but like 50 cents above that is this massive resistance coming from the monthly chart. So if you don't do that, you could be in for a treat.
Mm-hmm. I feel like so many times we put the blinders on, right? And we sort of look at one particular chart and then make all the conclusions based on that. You guys have all sort of illustrated why it's important. And honestly, most of you guys brought some really long-term charts, or at least we talked about that. And I think that's really important to think about it. Not just, it's very easy to get sucked into the last month and not think about that's 1 month among many we can look at over time. We're almost out of time.
Also, it gives the show a little bit longer term shelf life. Because if we were talking about hourly and daily charts, we'll be old by the end of the week.
This has staying power, okay, for a long time, viewers. Jeff, I wanted to get to your point, because before we went live, we were talking about the put-call ratios. You had a great observation about this acceleration to the upside in the put-call ratios, the equity-only put-call ratio we're looking at here. And I'm going back quite a bit. I'm going back to 2008 to give a good historical reference. But can you talk a little bit about what you see here and what it means to you?
Well, I'm not 100% sure how to interpret it. Let me frame it that way. But we did put up a new all-time record high as of yesterday's close in the equity-only put-call ratio. Now, there are a lot of potentialities. Maybe there's a data glitch and it's wrong. Maybe there was one trader that did some radical repositioning. I'm not 100% sure how to read it at this point, because if the market was at a low, in other words, if this was October 13th and we saw that data, I would be very convinced that October 13th was a low, right? But we're 16% higher than that today, which is kind of right in that 13 to 19% range that we saw in that, February, April rally and June, August rally. So I think we're closer to the end of the bear market rally than we are to the beginning. And I would note that if we go all the way back to 2008, we can see the second highest ever put call ratio on the equity only data series. And that occurred in March of 2008 before panic ensued. And so there's one other period of time that I can look to, and that's 1937, where we had a similar panic ahead of the decline. And we might even be able to say that around 1929 too, but there's no put call data that goes back that far. There are other measures that we look at that confirm that in terms of sentiment, but the panic sometimes begins before the decline. Then there's a secondary panic, oh my gosh, maybe it's the end of the world panic. And that's the one you buy. I don't think that's it today. I don't think we have an end of the world panic going on right now. So it remains to be seen what this means.
Really, really interesting. But I've seen a number of indicators, as we discussed, that line up in some ways to sort of that mid 08 period. And again, that's why I'm so glad, Jeff, and for all of you guys did a great job of talking about not just the potential reward, but the potential risk, right? This is a great trade, but if we break below this level, this is where you need to protect your capital. So as always, let's remain wary, even if you are on the bull side. Guys, an hour came and went, and we are done, but it has been a pleasure chatting with you guys. I love this opportunity to have a discussion and share some of your expertise with our viewers. So Jeff Hughes, Julius de Kempenaer, John Kosar, thank you guys so much for sharing your time and your wisdom, and appreciate you participating today.
My pleasure, Dave.
It was fun.
All right, folks, that's it for this episode of The Pitch. I'm Dave Keller, Chief Market Strategist at StockCharts.com. All of our previous episodes and some great picks over the course of this year and our previous years can be found at StockCharts.com/The Pitch. For StockCharts, I'm Dave Keller. Have a great one. We'll see you again soon.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.